So you're thinking about selling your home after 55. It should be an amazing next step, right? But for a lot of people, it can turn into a financial landmine. Today, we're going to uncover those hidden pitfalls to make sure your biggest asset works for you and not against you.
If that's you, then you are definitely going to want to stick around because just one little mistake, one poorly timed decision in this process can cost you a lot. But just how much are we really talking about here?
We're talking $10,000 or even more. And you know what? That's probably a lowball estimate of what you could lose if you're not paying attention.
And look, this isn't just about the capital gains tax you're probably already thinking about. Nope, we're talking about hidden Medicare surcharges and surprise taxes on your Social Security benefits. So let's dive in and break down exactly how you can sidestep all of this.
Okay, so it sounds super complicated, right? But believe it or not, this whole thing really boils down to just two simple variables. If you can understand how these two things work together, you've got the key to protecting your hard-earned money.
It's a tale of two things, really. On one hand, you've got your potential taxable profit from the sale. And on the other hand, you've got your Medicare timeline. It's how these two things dance together. That's where all the trouble and all the opportunity for savings really is.
All right. First up, let's tackle the profit side of things. The IRS actually gives you a massive tax break called the capital gains exclusion. If you're single, the first $250,000 of profit is totally tax-free. And if you're married, that doubles to a whopping $500,000, tax-free. Now, the only number we really care about for this conversation is any profit you make above that number. That's what we call your taxable gain.
Okay, so that's the part most people know about. Now for the stuff that trips everyone up. These are the hidden traps. Let me introduce you to something called IRMAA. Sounds kind of scary, right? Well, it stands for Income-Related Monthly Adjustment Amount. Basically, it's a fancy way of saying it's an extra fee, a surcharge, that Medicare tax onto your premiums if your income gets too high in a given year. And what's a great way to get a giant one-time spike in your income? Yep, selling your house. Right, so that taxable gain we just talked about, the government sees that as income. And that's what can easily launch you into a higher income bracket, which then triggers these really expensive IRMAA surcharges. But here's the real kicker. It's the timing of it all that catches people completely by surprise. See, Medicare has this 2-year look-back rule. It's kind of weird. So let's say you sell your house in 2026 and get that big chunk of cash. Well, the Social Security Administration won't even look at your 2026 tax return until sometime in 2027. So the nasty surprise? That doesn't show up until 2028. That's when you suddenly get hit with way higher Medicare premiums, all because of something that happened 2 full years ago. It's this delayed bomb that gets so many people. And you can really see what I'm talking about here. That bar on the left, that's your typical retirement income. Pretty steady. But then, bam! You add that big capital gain from the house sale, and you get this massive 1-year spike on the right. That is the exact thing that sets off the IRMAA alarm bells, and the hit to your wallet can be huge. Just how huge are we talking? Well, these surcharges can be over $12,000 per person per year. Think about that. For a married couple, that's potentially over $25,000 in extra Medicare costs, all just because of how and when you sold your home. And that's not even the only hit. Oh yeah, it gets better. It's not just Medicare that comes after you. That same income spike, it delivers a nasty 1-2 punch right to your Social Security. That gain gets added to your combined income, and that can easily push the amount of your Social Security benefits that are taxable all the way up to the max of 85%. So you're getting taxed on the gain itself, and then you're getting hit again with higher taxes on your Social Security. It just chips away at 2 of your most important retirement pillars at the exact same time. Okay, so how do you avoid this mess? It really comes down to getting the right advice from the right person at the right time. But that leads to the big question, right? Who do you even talk to?
And this is a really, really important point that a lot of people get wrong. You see, most of us think our tax person, our CPA handles all this. But their job is really about compliance. They're like historians. They look at what already happened last year and report it correctly. A financial planner is more like an architect. They're looking forward, helping you design the best plan for the years to come. Let's break it down even simpler. The financial planner is all about strategy. They help you answer the when question. When is the absolute best time to sell to avoid these traps? The CPA, on the other hand, is tactical. They answer the how much question. Once you've decided when to sell, they figure out exactly how much tax you'll owe. In a situation like this, you really need both. They're two different but equally critical parts of the team.
So, how do you figure out if you're in one of these complex situations? Don't worry, there's a pretty straightforward way to think about it. It's just 3 simple steps. First, you need a rough idea of your taxable gain. Remember, that's the profit over your big exclusion. Step 2, check your age. Are you in that critical zone, say, between 63 and 67, right around when you're dealing with Medicare? And third, you just match those 2 things up to figure out your game plan. And here's what that game plan looks like. If you have a pretty small gain and you're nowhere near Medicare age, you can probably figure this out on your own. But look at that bottom right box. That's the danger zone. A big gain and you're close to that Medicare timeline. That's when you absolutely 100% need to talk to a planner first. They set the strategy, then you bring in the CPA to handle the nuts and bolts.
But is paying for this advice really worth it?
Oh, absolutely. For people in that danger zone, the ROI on a few $1,000s in professional fees is usually somewhere between 300 and 600%. We're talking about saving tens of thousands in taxes and penalties. It's a no-brainer.
So if there is one single thing I want you to walk away with today, it's this: time. Time is your most valuable asset in this whole process. The earlier you start thinking about this, the more control you have. It's that simple. If you give yourself a year or 2 of runway, you're in the driver's seat. You can pick the perfect time to sell, manage your income, and save a ton of money. But if you wait until you're just a few months out from the sale, you're basically just doing damage control. Most of the best opportunities are already gone.
And let me be crystal clear on this point. The second you sign on that dotted line, the moment you've accepted an offer on your house, the game is pretty much over. At that point, something like 90% of your best tax planning moves have vanished. Poof. Gone.
So it all comes down to this one question. For most of us, our home is the biggest asset we will ever own. So are you really giving its sale the kind of smart, strategic planning that an asset that important deserves?